Sastrikant, welcome and good morning, everybody. Choppy trading in Asia as we are 1 hour away from Trump's sweeping reciprocal tariffs kicking in, including a 104% rate on China. But countries, including India, are lining up to cut trade deals with the United States to lower those tariffs. All of which makes for some tricky decision-making for the Reserve Bank of India, widely expected to cut by 25 basis points today. But could it signal a willingness to do more? Good morning, everybody. Welcome to Inside India. The markets in India join us in about 45 minutes' time. The Nifty did close 1.7% higher yesterday. Gift Nifty futures are indicating a lower open driven by the global equity sell-off that continues due to escalating tariff tensions. And as we mentioned in the headline, a little over an hour to go before 104% US tariffs on China take effect shortly after midnight. So that has implications for India, arguably, quite possibly in a positive direction, because that tariff differential with the rest of the world, including India, just continues to widen, arguably in India's favour. Let's wait and see. We are also continuing to watch the currency markets, the rupee, which strengthened about 2% in the last month, but weakening again ahead of the RBI decision today. Quick check on the bond market and the benchmark India 10-year bond yielding just under 6.5%. 25 basis point cut expected by the RBI, but the outlier is a front-loading of a bigger cut of 50, not a base case for many. And if that did materialise, it could very well be counterproductive and could well panic the market. Markets also watching out for revisions in the growth projections and any shift in the wording of the policy stance from neutral to accommodative. Also, let's take a look at US equity futures, which are lower as we count down to Trump's global reciprocal tariffs set to kick in under 2 hours from now at midnight Eastern time. China's set to be the hardest hit with Trump's 104% tariffs after he slapped Beijing with a further 50% in the past few days in a tit-for-tat move. The president speaking at a Republican congressional committee event just a few hours ago.
After all of the abuses they've perpetrated, China's attempting to impose additional unjustified tariffs. Just so you understand, they all got rich because of tariffs. That's why additional tariffs on Chinese goods are in place effective midnight tonight at 104%. They want to make a deal. They really do. They want to make a deal. They just don't know how to get it started.
Trump's other reciprocal tariffs also kick in at the top of the next hour. US Trade Representative Jamieson Greer telling the US Senate overnight that Trump will not have any exclusions or exemptions, even as countries line up to seek some reprieve.
Other countries signaled that they'd like to find a path forward on reciprocity. China has not said that, and we will see where that goes. I think we need to work with our closest friends to make sure that we have trading arrangements that work. And if the Chinese are open, we'll see what. But they haven't signaled that at all. So I don't think that's in the very near term with China.
26% duties on Indian imports come into effect at the top of the hour, and India is just one of the countries negotiating a trade deal with the US. But Finance Minister Nirmala Sitharaman says the government is seeking bilateral trade deals with other countries. She's currently in London to speak with the UK Chancellor Rachel Reeves. And one area that India could potentially benefit from, iPhone shipments. The country's technology minister saying it exported 50% more iPhones in the last fiscal year. Apple had been turning more towards India as a manufacturing base since COVID disrupted supply chains in China. A lot of dimensions to the macro markets as they apply to India. Let's bring in Sanjay Nair now, president of ASSOCHAM, the Associated Chambers of Commerce and Industry of India. Sanjay, thank you for joining me. Would it help confidence amongst your members if the RBI cuts the repo rate by 25 basis points expected and quite possibly signals a commitment to do more?
I think the members are pretty bullish about it, and I think they're quite positive that it's going to happen. And I think that is probably feeding into the system itself. I personally felt that maybe they should adopt a wait-and-watch policy because what we need is more liquidity, which they've injected quite considerably. And as you know, the rate transmission in India is not extremely efficient. And in fact, banks are still struggling to get high-quality deposits. So I'm not sure what it does, except obviously we need lower cost of capital. But, frankly, we need to see folks borrowing and using it for corporate capex, not just for personal consumption. And that's my little bit of worry. But look, a rate cut is always welcome otherwise.
Understood. In the current environment, Sanjay, do you feel that 6.7% headline growth is now at risk?
For FY25, I think you have 6.4 in the bag, I think. I'm not, again, much in the know, the inside, but I would say that a couple of years, 2 years out, you should see 10 to 11, maybe 11.5% nominal growth. So I would say 6.5 to 7, I would say is a base case for 26, 27. And of course, there are many uncertainties, which I'm sure we'll talk about.
Let's talk about that. How then would you characterise sentiment, confidence amongst your membership, Sanjay, and are your members at this stage inclined to put capex, hiring, expansion plans on hold, or is it business as usual for them?
I think for the time being, it's business as usual. I think it's too early. When our members just take a step back, and also folks like us from the corporate world, we just have to see that India itself is a massive local opportunity. And the government here in the last couple of years has driven 3-4 things which are very important to note, right? The whole formalization of the economy, the digitization, the GST rationalization, and the PLI, the production-linked incentives they gave. Plus, we are fast-tracking a lot of FTAs. 3 are done, 3 or 4. They're on kind of a war path to get a few more done, which they were doing even before the announcement. So I think they have been very proactive on that. So leave that as it is. And then you look at a huge domestic economy, which may not be firing on all cylinders, honestly, especially consumption. So I think that if the government will wait and bridge another 6 months to a year of infra spending and the government expenditure, and then crowd in the private capex.
Yes, I
think that's when the members will really begin to see the green shoots, because private capex is still not picking up to the tune it should. And maybe it's got to do with the old adage, ease of doing business or whatever. And I think that's a bit overdone. We got to get very specific. What are the issues? And those are being addressed head on. So I would say nothing has changed per se, but we cannot be sanguine about what's going on. At least I'm not. And I think we need to act both on the government side, which they're doing a lot, and the private sector really needs to step in.
Can you give us a bit more detail, Sanjay, about the challenges domestically, and how deep is the consumer stress at the moment? And would you go as far as saying that this is a consumer confidence crisis, and what can be done to arrest it?
No, I don't think it's a consumer confidence crisis. I think the household debt has gone up, and obviously the regulators are extremely watchful, so are the banks. I think the larger issue is job creation, wage growth, and a secular trend pickup, which you should see as a result of that in consumption. You see a lot of cyclical ups and downs, but you got to see a secular pickup in consumption, and that is the key. So I think we should not misunderstand low consumption with household stress. I think folks are trying to save to repay the loans. And I think the first cut that will come because of this budget announcement of making the first slab tax-free gives people 30 to 40,000 rupees in their pocket. I think they're going to try to repay the debt and then sort of begin the consumption cycle. But
yes,
frankly, ultimately, you need job creation and wage increases, which is really what will lead to a secular pickup in consumption. And when corporates see a secular pickup in consumption and 70, 80, 82% of secular capacity utilization, that's when the private starts. And I think we're just there. But again, with this whole tariff thing, I think people need to recalibrate a little bit more.
Of course. And Sanjay, in a global environment where there seems to be a non-trivial risk now of stagflation, do you feel that a recurrence or inflation making a comeback in India, and there are signs that inflation is starting to stabilise, is something that you are concerned about, or the fact that oil seems to be relatively suppressed at these levels works in India's favour from an inflation point of view?
Yeah, I'm frankly, personally, less worried about inflation, and you'll hear, I'm sure, the RBI statement as well. I don't know what they're seeing. Oil prices really help. There's no doubt about that. I think the rupee has not weakened as much as some others have, and that helps a little bit. The inflation also earlier has been quite supply side bottleneck. That's why. And I think the supply side in this country in the last 4 years, with the amount of spending being done by the government on physical, social, financial infrastructure, the digitization, the supply side is far more debottlenecked. Of course, the agrarian economy is always up and down given climate change and given all the fragmented issues we have on the farm sector. But yeah. I would say if food can remain under control, I think oil, currency, and the supply side impetus that this government has given should really help us go through a period where inflation should not be the concern.
Understood. Sanjay, let's pivot back to the external landscape and situation. How supportive is ASOCHAM of a US-India bilateral trade agreement, and how material do you think that would be for India's export revenue?
Look, I mean, I think it's very critical, and this may be a call to action. This government was already in action mode, like I said, in terms of closing out FTAs, but now the PTA with US becomes, I think, extremely critical. 18% of our merchandise exports out of the US. It's not a small number. It'll be foolish to say we will not be impacted. I think we will be impacted. So the BTA is one way to clearly get some uncertainty out of the way. What is clear is that tariffs will have to come down, that we impose both non-trade and trade, which again means that the companies will have to become a lot more competitive, and there is no shielding away from the real competition that they're going to face. So that's number one. Number two, I think they will rejig their supply chains, which is good. The China plus one factor plays in our favor. You're seeing what Apple exports are. I just saw it on your screen. We will have to
Sanjay, can I just interrupt you on that score? It's very interesting what you said about Apple. And do you feel that Apple is close to doubling down on India as a manufacturing hub? And where then are you putting FDI in the next 6 to 12 months?
I think so. You've got to ask the US guys how they think about it. But I see no reason why they would not have a reliable manufacturing partner in India, whatever the value add be. And that value add is going to keep increasing as they get more comfortable with India. And I think India's resilience and consistency that has been now evidenced by Apple should encourage more FDI. So that's just a kind of a brief answer.
Sure.
So,
Sanjay,
you want me to come back? Yeah, sorry, go ahead.
Sorry if I can. And it's always a fascinating conversation, isn't it? When we're in an environment where India continues to restrict market access for BYD, but many are now openly saying that India and China should stand together in the face of US tariffs. I'm curious, does your membership share that view?
We source a lot of stuff from China, right? And I think we should not, I think at least, be too worried about value-added capital flow, investment creating flow, capex creating capital flow, and technology. And China should be, I think, treated, leaving out the political and the geopolitical issues, just theoretically as a banker or as a financial markets person. I think where we get capital and technology, we should welcome that. That's my view. Our members wouldn't be concerned, frankly, because they're always more concerned if the imports get cut off for whatever reason, because we import a lot from China. So I think that there is a bilateral positivity in managing that relationship, being a little bit more open. Yeah, you don't have to open up critical sectors and sell your companies, but there's a lot more that we could benefit from China.
Sanjay, IT services, pharmaceuticals, car makers like Tata Motors stand to be most affected by the tariffs. Can you give us a sense of how ASOCHAM and your membership is now actively engaged, perhaps, in looking at new markets, alternative markets, building on existing partnerships. And we know that Finance Minister Sitharaman is already in the UK having discussions with Chancellor Reeves. Existing partnerships in Europe, South America, Africa and ASEAN as an offset. What progress are you making?
So break it into two parts, okay?
Sure.
Where we need to get technology and innovation, I think the EFTA FTA with Switzerland, the 4 countries, Switzerland, Norway, Liechtenstein, Iceland, is an excellent one. I was recently in Switzerland, and you just see the kind of innovation going on there. And we need every bit of it, whether it's in chemicals, whether it's in AI, whether it's in electronics. So one is to bring in technology and to really give them market access to the extent they want. And every M&A that comes from there into India, inward, is welcome, okay? Because they come in there, they make our things more efficient, they buy companies or they inject capital, and they make in India, and for the world. So I think that is thesis number one, the one we have to blindly just go after. And I see the Ministry of Commerce and Industry really driving it, and along tangling with the Ministry of External Affairs. I think it's a great combo to approach these things in that manner. The second important thing is that our membership and other members as well of some other associations, they need to focus on enhancing our competitiveness locally. I mean, return on capital cannot be the only parameter that folks are focused on, return on invested capital. But what about investing more in R&D, in skilling? And we need to up the game, right? Because otherwise, how are we going to become an alternate either to China or face the competition that comes from market access, which is definitely going to be lower, right?
Yes.
Whichever way you look at it. And the third thing is, the more you look at EU, the more you're going to push back. You're going to get pushback on sustainability, labor, other things. So we just have to, we as in India Inc., has to really up the game on the technology curve, on the innovation curve, and invest more from the income and balance sheet towards R&D and skilling. I think we have been comfortable for rather too long.
Yes.
We have used the tax breaks that this government gave a couple of years ago as a shield, not as a catalyst. And I think, it's going to take two hands to clap, right? So government is doing what they're doing, and they're probably, marching in a certain direction and pretty proactively. I think India needs to really buck up and, put a few extra dollars to work on a long, patient capital. Hope for returns come later. Otherwise, how are they going to be competitive?
Enhance that value-added proposition. Sanjay, noted. We're going to leave it there, sir. Thank you very much indeed for joining me with your insights. Sanjay Nair there, President of ASOCHAM. I want to take the conversation now to the currency markets and bring you up to speed with China's onshore yuan, which has weakened to a new low of around 735.05 per dollar. That is the lowest since September 2023. This is important because this comes just before the imposition at around midnight US time of 104% tariffs, US tariffs on China. So perhaps this is the beginning of a broader aim by the leadership to depreciate and engineer depreciation in the yuan, in the currency, to help support the export side of the equation. But of course, eroding domestic purchasing power is the price they're going to have to pay. So it's always a double-edged sword. In the meantime, let's take a look at oil prices in early Asia trade, extending losses after a 4% drop in US trade overnight. WTI 57.68. We're now squarely below the 60 handle. Brent crude threatening to drop below that level. 61.02 is where we stand, down by almost 3%. We're back in 2 minutes. Welcome back. US President Donald Trump saying in a post on Truth Social overnight that he had a great call with South Korea's acting president Han Duck-soo, touting a potential great deal covering tariffs, shipbuilding, the Alaskan LNG pipeline, as well as military protection that the US provides. In the meantime, US-Japan trade talks are kicking off in DC. CNBC's Kaori and Joji is tracking those talks and joins us now from Tokyo. Hi, Kaori, and what progress has been made?
Well, it's hard to tell from this vantage point because most of the discussions are going to be held in Washington, D.C. But I can tell you that in 40 minutes, these tariffs are going to kick in, and all of Japan Inc. is very, very nervous. There are call centers being set up across the country, and there have been ringing off the hook since Monday, particularly from the small and medium-sized enterprises that could get obliterated once these 24% tariffs kick in, not to mention the 25% on the autos and auto parts makers. So people are talking about recession. They've been talking about a slowdown in economic growth in the first quarter of this year, even before these measures took effect. So if we're talking about, say, minus 0.3% to minus 0.8% are the forecasts I've been seeing in terms of the impact on GDP, you're looking at a very, very precarious situation, Sri, for the Japanese economy.
Kaori, if there is any offset here, then you would imagine a greater commitment by Japan to buy more US LNG, and the conversation is similar and parallels that with the bilateral trade talks that I'm sure are going on between India and the US. How much of a commitment and how big a role do you think energy will play in any deal that is cut?
I think energy is going to be a common denominator for many countries, and Japan, India, as you mentioned, particularly, and also South Korea. I mean, this interview with with Bassett overnight with CNBC was very, very telling. He dropped some major hints. Look what he said. There is talk of a big energy deal in Alaska where the Japanese will take a lot of the offtake and provide financing for the deal. I mean, it doesn't get more explicit than that. He's talking about a $44 billion natural gas project. Mitsubishi Corporation has expressed interest in the past to possibly up their investment in that stake. And as you know, this is a very fuel poor, energy poor country that needs it. And we have a president who doesn't believe in climate change. So I think LNG is particularly of interest, but there are other areas that they want as well. We've also heard the trade representative say that he wants more agriculture products into the Japanese market. They did a deal recently on beef. There isn't a whole lot of maneuver leeway, according to the economists I speak to, on the agricultural front. But I think industrial products, motors and things that make energy, when you're trying to move that energy, could be on the cards. Because when you look line by line at the items that Japan imports to the United States, that comes out pretty high on top. I mean, cars are all the way down. It's virtually non-existent, Sri.
I'd imagine defence is up there as well. Kaori, thank you very much indeed for that. Let's turn to Southeast Asia, and Vietnam is another country scrambling to negotiate with Washington as duties of 46% are set to kick in at the top of the hour. Let's bring in JP Ong now into this conversation. What does Vietnam have to offer, JP?
So this is one of the bigger trade surpluses against the United States. About top three, I think, about $123 billion US, Sri. And it seems that Vietnam is now sending their Deputy Prime Minister Ho Duc Phuc to meet with Treasury Secretary Scott Bessent actually in the United States at 4 p.m. Eastern time, which will be way after the implementation of some of these tariffs. Now, addressing and trying to mitigate this trade surplus will be a tall task for Vietnam, but they have actually identified one area that might be of interest actually on both an economic and geopolitical reasons that is, and that is increasing defense products and defense spending and buying more American defense products actually to help mitigate this. Now, as we know, the history of Vietnam in the United States is quite checkered because they did go into the Vietnam War about 60 years ago. But this time around, it seems there is an opportunity for American defense goods to actually come into the Vietnamese markets and actually supplement the Vietnamese military. We have to remember that Vietnam generally sources a lot of their defense products from three particular countries: Russia, Ukraine, and Israel. What these three countries have in common is that they're all embroiled in conflicts, and we've actually seen exports to Vietnam of these goods from these three countries drop to about but zero over the last 2 years for many reasons that perhaps aren't surprising. Now, this creates an opportunity for U.S. companies to actually come in, defense companies, to supply them with guns, to supply them, for instance, with other arms, tanks, and the like, apart from Coast Guard vessels. And of course, as we know, Vietnam also needs to upgrade their military and make sure that they have a tremendous, significant source. But this also runs a couple of risks, Sri. On one hand, you do have the switching costs because, again, switching from Russian to American systems, there are some switching costs and retraining costs that need to be accounted for. The second thing also is what China might make of Vietnam and other Southeast Asian countries upping or increasing their acquisition of U.S. military goods also. So, again, there are a few things they'll have to finesse also. It's not going to be straightforward. And, again, the question is, will this be enough, actually, to address that massive trade surplus that Vietnam has?
Well, things for sure. We're seeing an arms race in earnest in this part of the world, if not elsewhere. JP, thank you very much indeed for that. Coming up next, one of India's fastest growing airlines, Indigo, has got big expansion plans, but could US tariffs ground those ambitions? We'll hear from the company's CEO. Peter Elbers will be joining us in a few moments' time. Do stay tuned for that conversation. Welcome back. We are counting down to the market open in India, and this is how we are shaping up. We are looking at some weakness. 22,427 is where we are expected to kick off. So we are looking at about 100 or 200 points off a decline. Nothing disastrous, but the story really is about 104% US tariffs on China goods that are going to be kicking in at midnight US time. And of course, for China's manufacturing rivals like India, that of course increases the tariff differential, arguably in India's favour. So that is the offset in terms of the overall picture. But let's wait and see what this global market volatility does and whether it sinks all the boats in the harbour, which seems to be the narrative at the moment. In the meantime, shares of Interglobe, parent of Indigo Airline, recovering, as you can see there, from the market fall on Monday to soar to a record high on Tuesday. And in the last 2 months, you can see that the stock has been up nearly 20% after Indigo's bullish outlook last month to increase its share of international capacity to 40% by 2030 from the current 28%. Indigo is already a major player in its domestic market with a 60% share and commands nearly 20% of India's international flight market, flying to 40 destinations worldwide. Last month, it also entered the European long-haul market with non-stop flights to Manchester and Amsterdam, and it's planning to increase its fleet to over 600 within the decade. It will include leasing Boeing Dreamliner jets. Big question now, how much will Trump's tariffs change all of that? Let's put that question now to Peter Elbers, CEO of Indigo. Peter, great to have you on the programme. So all-time high on Tuesday for Interglobe, which operates Indigo. So the market at least believes that Indigo is well positioned to ride out this uncertainty. What's the stock price telling you, and how much conviction do you have in the outlook?
You know, at Indigo, and good morning, and thanks for having me with you. At Indigo, we're in fact a very much part of the India growth story. And Indigo has developed in the past 18 years from a very domestic-oriented, low-cost airline into basically the market leader in India itself and increasingly international. And the potential of India with the economic growth and the growing middle class is enormous. And I guess that's been reflected in the appreciation of that stock price indeed.
What are the odds, Peter, of a global trade war and a global recession, and how is this going to impact travel demand for business and leisure within India and inbound and outbound?
You know, when we look to India, and India it's on its way to become the third largest economy in the world, the penetration of air travel is still very, very low. And if you compare it to Europe or for that matter to China, the air travel penetration is low and the need for mobility, both domestic and international, is high. So the combination of a growth of economy, a growing middle class, a young population, coupled with a low penetration today in terms of air travel, makes the outlook for us very bullish. And we've set a path to double by the end of the decade. And basically we've announced that strategy 2 years back, and we're well on the way in achieving those numbers.
Understood. Peter, where are you putting passenger load factors within, let's say, a 3 to 6 month time frame?
You know, the Indian market is very late booking market. And from that angle, giving any load factor predictions for the next 6 months is I guess, just a wild guess. I think what is important for us is what we have seen, actually, even with some of the sort of outside dynamics and global dynamics, that the demand in India and the domestic demand in India and the Indians going abroad actually has been so far unaffected by these elements. We've seen healthy loads, we've seen good development, you've seen our earnings for the third quarter, which were positive. So from that angle, actually we see a continued outlook as we have seen over the past quarters.
Peter, you're painting a very bullish picture about the demand prospects in India, but can we say the same about international markets? And where then is that putting your plans for a fleet expansion? Are you having any second thoughts about where you're going on that score? Or, again, is it business as usual?
I would say the latter. It is business as usual. And we're thriving on two factors. One is the increasing demand from India itself for going international. And perhaps traditionally that was very much oriented from India to the Middle East. Nowadays, and especially looking at the geographical position of India, where 65% of the world population is living within 5 to 6 hours flying range of India itself. So we're not only benefiting from the Indian market, but also from a huge opportunity to connect over India for international markets. And from that perspective, India was lacking a global hub position and clearly has the ambition to become one. So that combination of a strong, growing domestic and increasingly international market and the opportunity to connect gives us a lot of confidence in our plans for further internationalization.
Understood. Peter, what does the aircraft order book from Boeing look like? And how confident are you that suppliers can fulfill those obligations if there are possibly manufacturing supply chain issues that are arising because of tariffs?
Yeah. Well, we are I would say 98% Airbus operator. We have a couple of damp leases in Boeing, and for the rest, we're an Airbus operator. We have a massive order book, probably the world's largest order book, with over 900 aircraft yet to be delivered. And these 900 aircraft are coming in pretty much in the phasing of one aircraft every week. This financial year, which started on April 1st, we are entering the Airbus XLR into our fleet that will further expand the range of doing. We've ordered the 350s coming in 27, and in order to bridge between today and 27, we have taken some 787s on lease from Norse in order to prepare for that further long-haul expansion we're doing.
Peter, and so far, the word from Airbus, no cancellations, no delays, everything is on schedule?
Yeah, I mean, there's always, I would say, a natural tension globally when it comes to supply chain challenges, and Indigo is not excluded from those global challenges. But over the past 2 years, I think Indigo has demonstrated very well to be able to have a whole range of mitigating measures and to live up to our capacity guidance. We closed last calendar year with 113 million customers, and that's up from 78, which was there prior to COVID. So I think that entire ambition to continue to grow has been materialized despite some of the global supply chain challenges.
Peter, are you factoring in a lower price outlook for jet fuel? And if so, where does this leave the pricing environment for airfares?
You know, the fuel price, I guess, is a factor where, you know, we just have to deal with. And in the long range, there's always a reflection in airfare tickets as related to fuel prices. I think what's very important for us is that we maintain our cost leadership. Indigo has a fantastic track record when it comes to a cost leadership with that dimension. Of course, we'll deal with the fuel price. We also have the lowest, or actually I should say the youngest fleet, lowest emissions fleet for all airlines larger than 100 aircraft. For 3 consecutive years, we're in that league of having the youngest fleet. I think those elements are helping us a lot in order to maintain that cost leadership despite some of the variations in fuel prices.
Got it. And Peter, there's no reconsidering at this point the major push that's underway at Indigo into cargo, given the global economic uncertainty, or are target markets like Saudi, GCC looking resilient regardless?
No, not at all. I think we have a long-term view at Indigo. The Indian air travel market has been underserved and underpenetrated for a long time, and as we call it, this is India's time, and India's in a hurry, and so is Indigo. So our ambition to take part of that pie, where a lot of cargo today is being shipped in and out of India with non-Indian operators, I think gives us a great opportunity to take some of that market share. And a lot of initiatives are taken in India to develop more manufacturing next to the services industry. And I think that's a very promising sector for India, and hence we're taking big steps also on the cargo side.
Got it. And how are you positioning, whether it's cargo or commercial, the airline to capture the India GCC corridor, which is flourishing?
Yeah, well, I think there we are very well positioned. We operate over 200 flights a week between India and the UAE. We fly actually dozens of different routes from different points in India to different points in the UAE. That percentage will continue to grow going forward. So we're actually very optimistic on that part. That was the first part where Indigo moved international. I think today we have developed a very solid position there, but we've recently added flights into Central Asia, Africa, Indonesia. So really connecting those flows over different points. And there we really see that the effect even of connecting flows are helping a lot.
Peter, great conversation. We'll leave it there, sir. Thank you very much indeed for joining us on Inside India. Peter Elbers there, CEO of Indigo. Thank you. Right, counting down to the market open in Mumbai. We are back in 2 minutes. Welcome back. We're watching the Indian rupee ahead of the RBI decision today. This is where we stand, and the rupee under some pressure against the US dollar at 86.5570. CNBC TV 18's Ritu Singh has a preview of what to expect.
Amid the tariff tantrums, the focus now shifts to the central bank's next move, and respondents to our CNBC TV 18 poll of top bankers, economists and bond dealers expect the RBI's Monetary Policy Committee to acknowledge these global risks but remain firmly focused on domestic dynamics. Now, most expect RBI to front-load its rate cuts in April and June as tariffs threaten to hurt economies globally. Now, all of the respondents to the CNBC TV 18 poll expect the MPC to deliver a 25 basis point rate cut in this policy, with inflation cooling, growth slowing, the dollar weakening, US yields dipping and crude prices falling. The RBI does have room to act, so the call on the rate cut is unanimous, but the question is, what else? Now, here's where opinions start to differ. Half the respondents expect a shift to an accommodative stance, signaling a more dovish RBI, but 40% think the MPC will stick with a neutral stance, keeping options open amid what is a very uncertain environment. The terminal repo rate is seen at 5.5% by the majority, and that implies a total rate cut of 75 basis points in this cycle. No major liquidity surprises are expected. Now, RBI has already been addressing tight liquidity through OMO purchases, currency swaps, higher tenor VRR auctions, and it is likely to continue doing so. Any more here is going to be seen as a positive. Now, economists expect anywhere between 30 to 60 basis point hit to our GDP because of higher tariffs. But for now, the majority expects RBI to leave the growth forecast for this fiscal unchanged, while a small section does expect a little bit of a downgrade. On inflation, which is tracking below RBI's estimates, 60% believe it is going to be left unchanged, while 40% see it being revised lower to a 4 to 4.1%. Now, the tone of the policy expectedly will be dovish in the face of emerging external risks. With inflation under control and growth headwinds building up, the RBI may just choose to lay the groundwork for further easing in the months ahead.
Thank you for that, Ritu. And Indian markets are just joining the trading day, and they are looking softer. Nifty 50 off by about 0.7%. It did kick off down about 0.3%, but it is gathering some negative momentum. That may be because the pharma index is down quite heavily in terms of the sector level action after President Trump reiterated tariffs on pharma imports. The IT index also down quite heavily at a sector level by more than 1%. The saving grace, of course, could be the RBI, and a willingness and an intention to do more beyond the 25 basis point rate cut, which is expected in the repo rate. Let's bring in Sonal Varma now, Chief Economist, India and Asia, ex-Japan at Nomura. Sonal, great to have you on the programme. Will the RBI revise the growth forecast lower? I know that Nomura as a house has done, and what can we expect?
Well, they definitely should be revising the forecast down. RBI is currently expecting growth to actually accelerate in the ongoing financial year to 6.7 from last year's 6.5. But the incremental developments, particularly in the last 1 week, the tariff shock and its impact both directly on India but indirectly through the weaker global demand and uncertainty channel clearly means the 6.7% looks quite optimistic. Our own view is RBI is likely to cut the numbers probably down to around 6.5%, which in our view is still too optimistic. We think growth will be closer to 6%.
I understand. The outlier is front-loading 50 basis point cut at this meeting, Sonal. Is that going to happen, or would that panic the market?
I think it'll be probably seen as a panic signal. Now, just to be clear, at 6 quarter, which is where the repo rate is, we are, in our estimate, 75 basis point above neutral. So you could argue that there is a case to be made that there's room. Why not just front load it? So it's, one of the policy options. But as you said, I think from a signaling perspective, given we are still very early in terms of determining what the exact impact will be, And India, in the relative scheme of things within Asia, is one of the least exposed from higher tariffs. So I think the panic signal from a 50 basis point probably is too much. So a 25 with potentially an accommodative stance should do the job.
Understood. And Sonal, what then are you pricing in terms of a dovish outlook and dovish signalling by the RBI? Are we talking about cumulatively 50, if not 75 basis points in cuts over the course of 2025?
Yes, that is our view. So we are expecting back-to-back rate cuts in the next 3 meetings, so 75 basis point in total. And alongside this, the liquidity side, which is quite important for policy transmission in India, RBI has been fairly aggressive, and banking system liquidity has moved into a surplus. A commitment from them today in terms of keeping banking system liquidity in a sustained surplus going forward would be an important positive signal that will reinforce policy transmission and enable banks to actually cut policy rates, the lending rates even further. So the liquidity signaling is something the RBI could do as well today. And I think things are extremely uncertain, but we know that there are downside risks both to growth as well as to inflation, given the big drop in oil prices. And therefore, the communication and the forward guidance that the RBI remains open to doing whatever it takes to support growth while ensuring stability. That messaging will be important.
Sonal, how material or marginal could a BTA, a US-India bilateral trade agreement, be if it is struck, if it is if it does materialise?
It could be material. So the broader framework of the bilateral trade agreement in terms of tariff, non-tariff barriers, giving more market access for U.S. firms, and also cooperating on longer-term supply chain partnership resilience. The contours of this agreement have been finalized. Now, the negotiations will take time. From India's side, it does appear that the government is open to reducing tariffs on a number of products and potentially increasing the market access, buying more of U.S. products, which is one part of the deal. The expected timelines on this, though, is a bit far out. So around September, October is when the first phase of the trade agreement could be signed. Now, there are two potential benefits to India from here. One is the existing reciprocal tariff rate of 26%. If it is brought down slightly, would still give India an edge on a relative basis, particularly compared to the competitor export nations, which is Southeast Asia and China. And second, I think the partnership on supply chain over the medium term is important because India is looking to benefit from the supply chains that are moving from China.
Understood. And just to be clear, how likely is it, Sonal, that RBI will change its stance to accommodative from neutral currently, and that will give us some insight into where they are in terms of directionally easing and more rate cuts?
It is a coin toss, but I would say, it's at the end of the day more of a signaling device. At the end of the day, we know that there are further rate cuts on the cards because inflation is at target and output gap is actually looking like it is going to be negative. And through the aggressive liquidity easing and moving banking system liquidity into a surplus, the RBI has already shown its hands and actually signaled that they are accommodative. So the official change in stance from neutral to accommodative would be a stronger signal. But even if, let's say, they stick to the neutral stance, the forward trajectory in terms of both the rate cuts and liquidity easing will still remain the same.
So now, in a global environment where there is a non-trivial risk of stagflation, where are you putting the inflation outlook for India domestically? And I suppose what works in India's favour is oil prices are coming down significantly, but we have the vagaries of the monsoon, we have the vagaries of agricultural production, and of course the consumer seems to be somewhat stressed with relatively high levels of household debt as well. Where does that put inflation on a 6 to 12 month horizon?
On our forecast, inflation should average close to the RBI's target of 4% in the next 6 to 12 months. In fact, we could have the next 6 to 9 months of inflation actually undershooting the midpoint of the target, so more in the 3.5% to 4% range. As you said, food prices remain a risk. I mean, if it's a heat wave, then perishable prices could pick up. But the more sustained drivers of or the sticky components of food inflation, the outlook there looks positive. Wheat output has been higher, and the expectation is this year's monsoon season will be normal. Importantly, I think, given the demand hit that India is seeing and the negative output gap, plus the risk of some redirection of the excess capacity in China or elsewhere in the region, I think disinflationary forces actually look more likely than inflationary force. So we are not that worried about inflation.
Sonal, do you feel that big MNCs like Apple, given the tensions in the global trade landscape, could double down on India as a manufacturing hub? And where then is there upside to FDI on a 6 to 12 month basis?
Yeah, we do think India is going to be one of the biggest beneficiary of the ongoing and the next round of supply chain shifts. Now, FDI in the current global environment we are in, typically there is a pullback of all kinds of investment, whether portfolio or direct. So it might take time for FDI to come in. May not necessarily be a 6 to 12 month story, more of a 2-3 year kind of a story. But I think there are two aspects for India which should be favorable. One is the reciprocal or the aggregate tariff rate differential between India and China or Vietnam is in favor of India. And therefore, in the short term, it does make sense for a lot of the MNCs to divert some of their production from China, Southeast Asia into India, where the tariff rates relatively are lower, and there is scope to lower the tariff rates further. But second, from a medium-term perspective, a more strategic shift in these manufacturing facilities into India we think is likely because India is a strategic ally of the U.S. It is working with the U.S. on more longer-term partnership. And the government is also quite keen in terms of the subsidies that are coming through to the production-linked incentive scheme. So we do see benefits both near-term and medium-term.
Sonal, thank you very much indeed for those insights. Sonal Varma there from Nomura. That wraps it up for this edition of Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.